New to the mysterious realm of Australian taxes? Fear not, I'm here to break down the basics of the Australian personal income tax system in a way that won't make your head spin. We will cover off Australian personal income tax brackets, super easy to use tax calculators, practical ways to minimize tax legally, how to lodge a simple tax return by yourself, and more. By the end of this video, you'll be ready to tackle your tax obligations with ease and confidence. Are you ready? Let's dive in. There are three main components in your Australian tax obligation: income tax, Medicare levy, and other taxes and levies, if they apply to you. First, Australia has what's called a progressive tax system. Income is divided into different segments. Each segment corresponds to a specific tax rate. As you move up through the tax bracket, the tax rate increases. This means the more you earn, the higher the percentage of your income that goes to taxes. Picture your income as a multi-layered cake. For each layer, the ATO slices off a different portion. The bottom layer, the first $18,200, is not taxed at all. You get to keep the whole thing. As we move up to the next layer, the portion of your income that is between $18,201 and $45,000, the ATO takes away 19% of it. As for the third layer of the cake, the portion above $45,000 until $120,000, the ATO takes away a bigger slice, which is 32.5%. And we move up to the fourth layer of your cake, the portion of your income above $120,000 until $180,000, the ATO takes away an even bigger slice, which is 37%. Finally, the top layer of your cake, anything above $180,000, the ATO takes away almost half, which is 45%. The higher the layer of the cake, the larger the slice that goes to the ATO. Remember, the higher tax rate only applies to income in a specific layer of the cake or a specific tax bracket. For example, our friend John increased his income from $120,000 to $130,000 and moved from the third tax bracket to the fourth bracket. Only the income that falls into the fourth bracket, which is $10,000, is taxed at the high rate, not his entire income. This brings us to the concept of marginal tax rate. Essentially, this is the rate at which any extra dollar you earn is taxed. This is typically higher than your average tax rate, which is calculated by dividing your total tax by your total taxable income. In addition to income tax, Australians also pay the Medicare levy, which helps fund the public healthcare system. This levy is currently 2% of your taxable income. In our previous example, on top of the personal income tax, John will have to pay $2,600 in Medicare levy. If you have a higher income and do not have a proper level of private hospital cover, you might have to pay Medicare levy surcharge. This surcharge is on top of your Medicare levy. This can usually be avoided by taking out a private hospital cover. If you have outstanding help debts, you may have repayment included in your tax obligations. Now, one of my favorite tax calculators is TaxCalc. It's free and super easy to use. All you need to do is plug in your taxable income. But wait, what exactly is taxable income? Taxable income is basically your assessable income minus any deductions. Assessable income is essentially your top line income, the total sum of all your income sources. This could be your salary, interest from savings, dividends or distributions from investment, rental income, and so on. Deductions are certain expenses that you can subtract from your assessable income. The idea is if you spend money on certain things that are directly related to earning your income, then you shouldn't have to pay tax on that portion of the income. Common deduction categories include work-related expenses, investment-related expenses, personal deductible super contribution, income protection premium, charitable donation, and so on. To minimize your personal income tax, you want to maximize your deductions. There is so much more to say about deductions. So if you're interested in diving deeper into how to maximize your deductions legally and effectively, be sure to subscribe to this channel and hit the bell button. You won't want to miss what's coming up next. Now we have some fairly good understanding of the Australian personal income tax system. It's time to do some real calculations to see how this all works in practice. Let's head back to Tax Calc. By default, it's set for Australian residents. The income you enter doesn't include your super. Also, it assumes you don't have any health debt and you are not eligible for SAPTO. If you're curious about whether this applies to you, just click the question mark to learn more. Remember our friend John who received a pay rise and now earns $130,000? But wait, he's got deductions worth $15,000. So what's his taxable income? That's right, it's $115,000. Let's put this figure into Tax Calc, and voila! We can instantly see how much tax, including Medicare levy, John needs to pay. Now let's keep things simple and say John's only income is his salary. What happened here is that John's employer deducts tax from his salary before he even sees it. This is known as pay-as-you-go tax or PAYG tax. His employer doesn't know about his other deductions or income, so the employer calculates this pay-as-you-go tax based on his salary. This figure you see on the tax calculator is often the same as the pay-as-you-go tax. Each payslip John gets will show his salary, the tax that's being paid on his behalf, and what he actually takes home. Fast forward to the end of the financial year, it's time for John to do his tax return. He will enter his income detail and importantly, those deductions we talk about. And guess what? John's employer has paid more tax on his behalf than he actually owes, and he will get a tax refund. That's a nice bonus for being diligent with your deductions. Speaking of being diligent with your deductions, the easiest way is to download the ATO app, which allows you to take photos of receipts and documents during the year and save them directly on the app. When it comes to tax time, you can import this information directly into your tax return. If your financial affairs are pretty straightforward, you might want to consider lodging your tax return by yourself. The deadline of the DIY route is the 31st of October the following financial year. If 31st of October falls on a weekend, then the due date is the next business day. Technically, you can start lodging your tax return from 1st of July, but it may be easier to just wait for a few weeks. Why? Because the ATO has data feed from your employers and many other financial institutions. After waiting for a few weeks, you might find that a lot of your information is already pre-filled in the system. This saves you the hassle of collecting your information and entering it manually. If you decide to go the DIY route, you can lodge your tax return through MyGov ATO. It's super easy and very secure. And the best part? Usually you will get your refund back within just 2 weeks. Now, if your financial situation is a bit complex or you just want the guidance of a professional, you can always hire an accountant to do the tax return for you. Remember, the cost of managing your taxes is tax deductible. So the real cost of the accounting is... That's right, just checking if you've been listening. Congratulations, you just graduated from being a tax beginner. But did you know that everything is about to change from 1st of July 2024? Government's Stage 3 tax cuts are coming into effect. Curious about what's changing and how it impacts you? Watch this video to get all the details. And remember, stay informed and ahead of the game by subscribing. See you next time!